you can see the tweet that I posted saying that I'm conducting a webinar, blah, 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 please register here. And I got a bunch of responses and views and those kind of things. But my most interesting one was this one, which you probably can see in the middle of your screen right now, which says, so there's a friend of mine who says, Ajeet, talk about lean startup, data analytics, content marketing, problem identification, depending on who your target group is, but do not talk about funding. Now that is extremely interesting for me because this topic is on funding, but that brings up a very interesting point, as in, why would somebody not want me to talk about funding? And the answer is obvious. We have all attended an unlimited number of sessions on fundraising, where not necessarily every one of us, but many of us have read articles, seen videos, attended sessions, and every one of them will quite likely touch upon funding, if not be exclusively about funding. And the problem with that is that most of them tend to say the same thing. So on the one hand, I do want to cover the basics about fundraising in today's session, but on the other hand, I want to make sure that I'm telling you something which you have not heard of before, even if you have attended these sessions, right? So let us see how that goes. Maybe you can, I do not know if there's going to be a survey at the end of this, but maybe you can write in and tell me your thoughts about whether this session added value. I want to do like fairly few things in this session and try to focus on depth rather than breadth. I assume you can see my PowerPoint. I have not yet put it in slideshow mode, but I'm going to talk about investors. I'm going to talk about how to impress them. I'm going to talk about how you can, adapt your presentation to yourself, avoid common mistakes, not get into, deals which may not make sense to you, and then of course not do something which is suicidally bad for you. So this is basically the entire session, right? So I might spend like between 3 and 5 minutes per every one of these topics. Please keep sending in your questions. There's a question panel which probably some of you can see. It says questions. You click on that, send the questions in. The moderator will get the questions. I'm very happy to answer them. My favorite part of today's session, I must say, is the question and answer. Let's begin with the first part, which is that all investors don't have identical motivations. What does this mean? And why should we care? It's probably obvious to say so, but the fact is that investors come in for different motivations. Other than the common motivation that they would really like to put money into your venture and make more money back, so they want to really look upon it as an investment, I have found that there could be several other motivations that investors have. Loosely, I would define all investors into two categories. One would be those who are putting their own personal money in. So these could be angel investors, your friends, relatives, neighbors, etc. And then there are those who are formal or institutional investors who are investing other people's money in. So these could be incubators, accelerators, venture capital funds, seed capital funds, etc. Now, the difference in the motivation of the two of these is that when somebody is putting their own money, even if they have their own set of guidelines that they like to follow, the fact is that they can do whatever they want to do with it. For instance, somewhere in I think March of 12 or March of 13, I had, having lost a lot of money in angel investing, I had come up with a list of points that every one of my subsequent angel investments should have, and only when I get a check mark in that full list would I invest. Now, though I have invested in at least 10 companies after making that checklist, the interesting thing is that not even one of them had all the boxes checked. So because it was my money, I can do whatever the hell I choose, I went ahead and used my discretion in doing so. However, if you were an institutional investor, if you were investing other people's money and you had a certain list of covenants, that means this is what we do, you'd probably not be able to do that without undergoing a significant amount of effort. Furthermore, if you are using your own money, you may actually let the money stay in the company for a prolonged period of time. It is your choice. But if you are an institutional investor, you need to give returns to the people who gave you their money in the first place. So if you are a venture capitalist, you have to return the capital and interest, or rather the returns, to your own investors. And in that case, if I have to give the money back in 3 years, my patience level with you is going to be less than 3 years, because I have to. I have no choice but to return the money in 3 years at any cost. As a result, when I come into your company, my motivation would be to see what can I do in 2 years, as opposed to somebody else who might, whether institutional money or their own money, may say, hey, what can I do in 5 years? This is why you should understand what, in addition to making money, what is the motivation of the person coming in? Is the person interested in this space? Does the person have other investments in similar spaces? Is the person viewing me as a potential acquisition target or a merger target? Does the person want to potentially acqui-hire me later and view me a little differently than a mere financial investment? So these are some of the things that you need to keep in mind, because only when you understand what the motivation of the buyer is, will you know how to be a good seller. And the reason I use the word buyer instead of investor is also obvious, that the way I look at it is that if you're a business, you're in the business of selling something and taking money in return. In this aspect of fundraising, also you are selling your equity shares, or you are selling your ownership in your company, and you are expecting the buyer to pay you for that, which is the investor in this case. So if you think of investors in a sense as your customers, you might find this entire thing a little easy. Now, you know what I said, top 5 things. I do not have a list ready, so I actually said top 5 to make sure that I give you more than 1 or 2, and at the same time do not start rattling off like 10 or 20. So let's look at what impresses an investor. I think what I should also do is simultaneously tell you what does not impress an investor. Of course, when I'm saying something like this, I'm assuming that I'm speaking on behalf of all investors. Just hold on a minute, please. Hold on. Yeah, I'm sorry for the brief pause. Yeah, so when I'm saying that, what impresses an investor or what doesn't, I'm assuming here that there is only one type of investor, which is not the case. So everything that I say in today's session, you have to understand is my opinion. Okay, regardless of how valuable I think my opinion is, the fact is that you have to use your judgment and adapt everything I say to your situation. So let's begin with what impresses or doesn't impress investors. I'll tell you what I do not too much enjoy in investor pitches. I do not too much enjoy when entrepreneurs are throwing macroeconomic numbers at me, such as what India's population is, or how many mobile phones there are, or how many people are doing what, etc. Because see, these are good to know. Quite likely I know them already if I'm, a suave investor, and you telling me those is only telling me that this is a good time to start up in India, which I know, which is why I've chosen to be an investor. I would really like to know something very simple. What is it that you are going to do in terms of what is the value you add, what is the nature of your business? I want to know not just why that is a good thing, I also want to know why you think that you are suitable for it. Often what people do is they will come to me and say, hey, listen, today you can hire Ola or Uber cab so easy, or a truck it is so difficult, so we're going to make an app which does that. Or you want to order from a restaurant but you do not know which of their dish is good except for the 1 or 2 you've tried, so I'll have an app for that. So let us assume for a second that these might be good business ideas, but even if they are good business ideas, my point in giving you money would be when you tell me why you are suited for it, not why in general this is a good idea, because if it is a good idea in general, I will find the right team for that and you may not be it. To impress investors, 1 or 2 things that really work very well is if you have done your homework. I must tell you that I have probably a bloated or an inflated sense of how much my time is worth, but every one of you would agree that my time is worth something. In light of that, if I have decided to give you an audience, if I have decided to meet up with you or read your presentation, and you have basically put together something shoddy, I personally take it as an insult. Okay, and the point here is that if I am coming in seriously up to the table, you better be at least as serious. You are the seller here, right? So that I think would be the first part, to do your research. The second part is that not just your research, I want you to do some work before coming. So there are some investors, these investors are very, very, very few in number. There are some investors who do invest at the seed or pre-seed stage. Pre-seed stage I would define as the stage where companies are just having a business plan or just an idea, but you cannot expect too many investors to be interested in you at that point of time, and even if some of them are, you cannot expect any really large amounts of money to come your way. So the first thing that impresses an investor, more than anything else, more than even the research that I told you, is if you have already gone out there and done something. So don't come to me with just an idea, come to me with some level of accomplishment. Ideally, you would be a running business with a complete product and customers and revenues and profits. But that's what I said is ideal. Even if you can't reach that ideal, I would have liked you to do something. maybe have a prototype of the product if not the product, maybe have some initial customers who maybe have used your service for free, preferably they should be paying customers, but show me that you've done something. Please realize that even if today you were like an established business, like you're a Flipkart or a Snapdeal or a Redbus or any of those other big names, even then when I'm investing in you, I'm taking a huge leap of faith that I'm going to make money. And if you are not one of those names, and if the Bansals are not listening to my webinar right now, and they are not the ones who are trying to learn how to raise money, which I don't think I can teach them in the first place, if you are going to come to me, imagine that it's like an extremely high risk gamble. I don't have money to throw away. Nobody does. Well, maybe your friends, family, relatives, dad, father-in-law may be willing to throw money in your direction, but otherwise nobody really has money to throw away. In light of that, try to reduce my risk by saying, you know what, we need to have a product in place, we need to understand the customer mechanics, we need to service their needs, etc. And you know what, this is how we will do it, and you don't have to take my word for it, because this is what I have been doing for the last few days, weeks or months, and this is what it looks like. Right? So I think that is the number one thing that impresses investors. The second thing is that I cannot, okay, so I think probably I should call this the first point, because this is also as important. If I find or fear or suspect that the entrepreneur is not invested in the business, by that I mean that the entrepreneur is probably doing multiple things, or the entrepreneur is thinking, you know what, if I raise money, I will start doing this seriously, or the fact that, you know, yeah, I have a 6-month outlook, I'll see how this works out, etc. See, all of those would mean that you are respecting my money less than I'm respecting it, and that is not acceptable to me. In light of that, one of the extremely important points is if I get the feeling when I talk to you that you're fully committed to the space, right, or fully committed to being an entrepreneur. So that's 2 points. The third point I would say, which impresses investors a lot, is if they find that you understand what you're talking about. Now, what has happened is that when I come across entrepreneurs, I come across 2 types of entrepreneurs. One, who have a deep understanding of something. Maybe they have a family background, maybe they have work experience, maybe they have done projects, maybe they have deep understanding of a space, and they feel, you know what, having understood this space, I can come up with something which adds a lot of value. This is impressive. But at the same time, there are those who look around them and say, you know what, I think this is a problem in the world. So for instance, just a couple of days ago, somebody said, you know, Ajeet, you talk about investments, but you, from the entrepreneur's point of view, raising investment is so difficult that I think I will set up a website which connects investors, entrepreneurs, mentors, and people in the corporate world. I think that will be very helpful. Now, on the one hand, I do agree this is a problem. On the other hand, so many dozens of people have done the same thing, people with very strong backgrounds, that the fact that you do not know that this has happened infinite number of times before is actually very displeasing to me. So the third thing that I would add to this list is that you need to know the space that you're going to operate in, right? It should not just be that you ask me, don't you think the world would be a better place if I did this? I would say, hold on, the world would be a better place if somebody did it. I do not know if you're the right person to do it. So that will be the third point to add to the list. The fourth point to add to the list is the way you communicate with me, right? So now this is something which may not be very easy to do, but it is so effective if you are able to pull it off that I would recommend that you give it a shot. When you go across to an investor, your first contact can be made in a wide variety of ways. You could have somebody give you a reference, you could meet the investor who is speaking at an event, you could seek out their LinkedIn profile, join them, connect with them on LinkedIn and send them your investment request, etc. So there are so many ways that it can be done. However, what I find is that there is a significant influence on how you reached across to an investor in terms of how they would perceive it. So I think the best way, without any doubt, to reach an investor would be through a mutually known person. Now I know you could say, hey, listen, I don't have any common friend with the investor, and I confess it is not the easiest thing to do. But if you could cultivate relationships in the place, maybe even online relationships like LinkedIn, etc., and take some time, cultivate relations, and through that network across to the investor, the likelihood that this would lead to superior outcomes or you being taken more seriously is much higher. Keep that in mind. And my final point of advice in terms of impressing investors would be to realize that though the investors are in it to make money, as in that is certainly one of their objectives, if not the only objective, it is not enough to perform computations and to demonstrate your competence and understanding or even traction. They should figure they should feel that you are on their side. What does that mean? That means that when you make money, see, if you don't make money, everybody loses. Investors understand that. But if you make money, the investors should feel that you would take care of their interest. So you should seem to come across as investor friendly, because I must say that pretty much like, you know, a painful investor makes life hell for an entrepreneur. Likewise, a painful entrepreneur is also very irritating to an investor. So, you know, this space is full of people irritating each other. That's been my experience. So make sure you're not one of those. Let's move ahead to the fact that there is no formula. Make sure your pitch suits your reality. Now, I have come across some categories of entrepreneurs trying to raise money. There are those who probably are too early in the game, which means when they come to me, I feel, gosh, they've come to me a little too soon. There are those who are dying, and if they don't raise money like right now, they will just, you know, have to close shop, which is the other extreme. Then there are those who have come to me with, you know, a very good plan and implementation in one locality. These could be hyperlocal businesses, and they feel that now I need money to scale. There are some who come to me and say, I want money to develop the product in the first place. There are some who say, I want to quit my job, and since I have to earn money, I want you to invest in me so that I can pay myself. So everybody's reality is different. I have my own preferences of which type of reality I choose to deal with, but your circumstances are your circumstances. So I'm not going to dictate when you should be raising money. What you should know is that depending on your circumstance, your pitch should change. What this means is that the worst thing you can do is, because the internet has become an echo chamber, which basically means you can go and look at pitches made by so many other people. You can attend pitch sessions and see what others are doing. And if you find that there is a positive reaction to somebody's pitch, like for instance, about 6 months ago, one of the companies that I mentor went to a very prominent angel investor in India and talked to them about something, and that angel investor was extremely impressed. Now, time flew by and this business evolved. They did not raise money at that point of time, and they decided to go back to the drawing board, and 6 months later came back to an investor, this time another pretty famous angel investor. And when I put them together, I was surprised to see that the entrepreneur was giving a pitch very similar to the pitch given 6 months ago. And I was like, what? Your business has changed so much. You are now not even exactly in the same business space that you were in. And this entrepreneur told me, you know what, but it had worked, my pitch had worked so well the last time. It had got such a positive reaction that I thought I would do the same one. You get what I'm trying to say? This does not work. You have to make sure that the pitch sounds like it is your pitch. That's why I said don't try to go with a formula. Like, you know, I've heard of so many formulas. There's the 10, 20, 30 formula, which says 10 slides on a PowerPoint and 20 font size and 30 minutes. So I've heard all of these formulae, and there is some underlying merit to them, but I also feel that you should not waste your time in, you look at all the formulae, but come up with your own. Copying somebody's idea or formula, I have not seen it yielding a good outcome. So make sure that you pitch in a way that suits your reality. Now, let us talk of some common mistakes that you make, right? I've already talked about what impresses and does not impress the investor a few slides ago. When I was, I clearly don't know how to use PowerPoint very well, so let me just come back here. And so I have talked about it. Let me talk about it a little bit more. First, please understand that neither are you entitled to the investor's money, nor is the investor entitled to getting equity in your company. Both of you are coming together because it might make sense to the two of you. I know this sounds obvious, but often I find that, let us say an entrepreneur pitches to an investor and says, okay, here is my business in the healthcare space, or I'm coming up with a new hardware device, or I'm doing something in solar, etc. And the investor tells them that, you know what, I only invest in IT businesses or internet businesses. Please note, this is the investor's money, this is the investor's choice. Whether it makes sense or not is something that the investor will bear the consequence of. Pretty much like when you go to a restaurant, you decide what you want to order, right? Now, for you to go out and complain to either this investor or to the rest of the world that, you know, this investor doesn't make sense, etc., is extremely irritating. It is my choice, right? So I will decide what I want to do with my money, even if, by the way, I'm making a wrong choice. It still continues to be mine. Likewise, I cannot come to you, like for example, I find investors equally irritating when they listen to a pitch and they tell an entrepreneur, hey, you know what, I understand you have spent the last 1 year doing this, but why don't you do that instead? Sure, that is an input, and maybe the entrepreneur can gain from it. But if the entrepreneur has spent a year doing something and they feel committed to it and they have a belief in it, it's not the investor's place to dictate to them as if the entrepreneur is their employee, right? So it works both ways. So the first point that I said was that don't come in with a sense of entitlement, right? Which I think would be the biggest mistake. The investor does not owe you money, right? The investor does not owe you a 30-minute meeting. The investor does not owe you a phone call. The investor does not even owe you the courtesy of responding to your email. Of course, I hope they will, but I know that I get between 10 to 40 emails per day about something in this space. Sometimes it could be a pitch, sometimes it could be a query, sometimes it could be a request for a meeting, and I must say that I send out a large number of responses. But as a proportion, I know that more than 50% of my emails or messages go unresponded, and this is not because, okay, this may or may not be because I find that giving a response is going to be a bad idea. Because sometimes what happens is that the entrepreneur has a preconceived notion about what my response should be, and if I give any other response, it gets into an argument. So I say, you know, let us just stay out of this. Of course, this could be my prejudice, but I still don't want to get into an argument for no specific purpose. So I would say that keep that in mind also. Another common mistake that I have seen entrepreneurs make is they use what I like to call Chinese math. This is not my term, Chinese mathematics. This is not my term, I've read it somewhere, where just because they illustrate the size of the market, that there are so many people in India, so many women, so many pregnant women, hence if I have come up with something for pregnant women, it will have such a big market. Nobody believes that, right? Because that is almost like saying that anybody who can make computations of big numbers now can address a big market. That is nonsense. As in, it need not be nonsense, but for you to automatically assume that just because you can say the market size is very big, it makes sense. No, it doesn't make sense. That would be yet another common mistake. But you know, the most common mistake that I find, and this is not something I blame the entrepreneur for. I can blame them for thinking that an investor would be interested in it. I do not blame them for the choices the entrepreneur is making, is sometimes in their belief that a business is investable. Now you should know that this entire session that I'm doing is assuming a certain category of investors. So for instance, if you want to set up, let's say, a coaching class, or you want to set up a refrigeration repair unit, or you want to set up a, one of those businesses where you start getting customers, profits from day one, but it is very labor intensive, it's not capital intensive, it cannot probably be sold, or its value cannot increase, though a lot of profits and revenues could be made. These are the kind of investments where you go to, the neighborhood friend, uncle, aunt, somebody, a businessman who understands the space, etc. When we talk of venture capitalists, angel investors, etc., we are talking of a very different kind of company, the one which increases in value substantially, which is why in information technology and IT enabled companies tend to be one of the favorites of VCs, because this is a sector where a lot of value has been created. Now, if you do want to set up a company which probably, let's say, is in the area of providing consulting for search engine optimization, there's absolutely nothing wrong with that as a business idea. I encourage you to go all out and do that. But to automatically assume that you want to become a freelance search engine optimizer and then probably add many more employees and make it a large search engine optimization agency, to automatically assume that this, because it will probably make money and because there's an opportunity to gain customers, is an investable business, may be a mistake. Sure, so I don't want to disclose my own narrow-mindedness here, but in most cases such a thing would be a very good lifestyle business where there isn't really a need for investment. There is a need for you to put together a team, even if it is a team of one, which is yourself. Go out there and get customers and revenues. So the most difficult part that I find as an investor is in telling an entrepreneur that their business, the way they have defined it, is actually not investable in. So if I were to invest in it, I would be looking at something like, okay, give me 10% of the revenues you make. It wouldn't be that give me so much of your share of your company so that tomorrow I can sell your shares and make a lot of capital appreciation by selling it to others. It will be more along line of strategic partnership or loan that I might be giving you. By the way, I don't do any of those. So in light of that, what I'm trying to say is that make sure that your business is investable in the sense that the specific investor that you're targeting would like to invest in it. Right? So there are a couple of other mistakes that I could talk about, and I know that we need to kind of keep track of time also. Let's move to the fact that not all deals are equal. Much to my disappointment, I find that given that investors are so much smarter at doing investment deals than entrepreneurs solely for the fact that they have done this dozens of times. They might even have come across hundreds of deals and they themselves might have done about a dozen of those. I find that there are cases in which investors may actually be taking advantage of the entrepreneur, and actually, if I may use some harsh language, they might actually be exploiting the entrepreneur. This makes me extremely angry. I have come across such situations. These are not very common situations, but they keep happening once every few weeks or at least once a month. So what I would say is that please keep in mind that not all deals are equal. For instance, if I was a seller of biscuits, and if there were two customers, one of who was probably giving me more money for the same amount of biscuits, I think that both of them are equal, except one is giving me more money. I'd probably give it to the person who's giving me more money. If I was selling my used car, I would give it to the person who's giving me more money, etc. But when it comes to selling your equity shares, please remember that though I called investors your customers in a sense, they are actually very different from your customers in another sense. Namely, in a seller and buyer relationship, often the problems that a seller is going to face may disappear largely when the buyer has already paid them. Of course, there is the concept of after sale service, etc. But when it comes to being an entrepreneur who's raising money from investors, the investor actually becomes co-owner of your company, right, to whatever extent. And as a result, your relationship has just started when you make them the sale of your equity. As a consequence, what I would strongly recommend is just find out, is this the kind of person you want to be associated with? Is this the kind of person you feel thinks like you do? Is this the kind of person you would have taken on as a business partner? If not, you look out for some warning signs. I think the biggest problem that I would have, and your mileage may vary, but the biggest problem that I would have is with an investor who actually is viewing me as if I was his or her employee. The reason I choose to be an entrepreneur is because probably my nature is not too much that of an employee. I do not want to respond to a boss who asks me questions or give me orders on a daily basis. Of course, periodically I am answerable to the investor. But if I start feeling as an entrepreneur that the investor is going to treat me like an employee, I think that would be something I would run away from. The second warning sign I would have, and this, by the way, if you have tried to raise money, or if you have raised money, you have already encountered it. It is that common. So the second sign that I would try to run away from is wherein the investor puts in certain terms and conditions and covenants into the agreement that we sign, which I don't like. I bring it to the point, I present it to the investor and say, listen, why are you doing this? This I don't agree with. And then I say, no, these are all my standard terms. I hate that term. Standard terms, and don't worry, we are never going to use this. Think about it logically. If you're never going to use this, why are you putting it into the agreement? And to call something a standard agreement or a standard terms is just not cut ice. So I think somebody who is taking away a lot of rights in their agreement, which you do not agree with, so if you agree with those rights, I have no problem. But if you don't agree with them, please don't sign them just because of this mythical concept of standard terms or standard agreement. There is no such thing. Every term is up for negotiation. Sure, the investor may not want to give up certain rights. As a consequence, you negotiating on certain terms may actually lead to the point where they don't invest in you. So decide whether that is something that is so dear to you that you would give up on the opportunity to raise the investor's money. Yet another warning sign is where the investor is too meddlesome. Let me just give you an exaggerated piece of advice. That if the investor expects you to report to them on a virtually daily or weekly basis, if actually expects you to attend certain events or read a book because they told you to, or behave a certain way, or talk to certain people solely because they told you to, they are probably trying to be an indirect entrepreneur. Namely, they probably are in their heads thinking that I probably could not have done this by myself, and I know I'm using the word probably a lot, but I probably could not have done this myself, so I'm going to live my life through your eyes. So these are vicarious entrepreneurs. They're the worst kind of people to have. At one point of time, you have to tell them, listen, if you want to do business, you do your own business, but let me do my own business. So making sure that the investor will let you do your own business is, I think, extremely healthy, and if this gets worrisome, that's a huge warning sign. Today, you might be in such a situation where you might be desperate for money, so you may tend to agree or accept terms which you actually regard as morally wrong or unethical or totally unacceptable. I think that If you are feeling compelled to take money despite terms not being favorable to you, you are already in bad shape, because though you got the money today, you can rest assured that tomorrow this is going to explode in your face. So that would be a huge warning sign that if the investor actually expects you to do things which you regard as wrong, but you sign nonetheless, right? So I think the final warning sign I would like to talk about is when the investor does not take you seriously. This can happen when you are just a kid and the investor is extremely seasoned. Even then, please remember that you are into some form of partnership with the investor, and the investor is a very minor shareholder in your company. The investor is the minor partner. So the investor is not taking you seriously or treating you like a kid. I think it's too insulting for you to even be in that relationship. So how are we doing on time? I think we are at 15:50, which is 5 minutes more than I wanted it to be. All the same, I hope you have had fun. Where are we? We are at 158 attendees, which is much more than we started out at. So thank you very much for listening to me. I don't know if there are questions. If the moderator could just step in and send out questions if there are any. If you haven't yet sent in your questions, could you quickly get into the question box and ask me questions? I'm very happy to answer you.
Yeah, so thank you so much, Ajeet. And there are a lot of questions coming up. So I really don't know how much we can cover, but yes, I'm trying to, cover almost everything. So I think I can start with one asker called Mr. Gaurav Shah. So his question is, there are many business models who don't have a direct revenue plan and yet funded hugely considering long term, that is greater than 5 years estimates, like example of Flipkart, housing.com and many more. On what basis they make such decisions for funding such ventures?
Fantastic. So Gaurav Shah, good question. I must distinguish between Flipkart and housing, because Flipkart has a very clear revenue model because they sell goods, so obviously there's revenue. However, probably what you're referring to is that they don't have a very clear profit model. Housing, on the other hand, you are right, has a negligible revenue model because they almost charge for nothing. So let me just explain both of these to you. And this is actually a fantastic question. Look at it this way. Forget the venture capitalists, entrepreneurs, share capital, etc. Go even 100 years back. If you were setting up any business, maybe even if you're setting up a pawn shop or a retail outlet, or you are becoming a carpenter or any other business, it is easy to believe that there would be a period between the time you set up your business and the time that the business becomes rewarding. Now, rewarding could be revenue generating or profit generating. This you could call gestation period, and this has always been there. What has changed today is that the abundance of high risk capital has also made this capital patient. What that means is that while earlier a shopkeeper may set up a shop and hope to start making revenues from week 3 and profit from month 3, today it is possible for a lot of these people to wait for years altogether. I must point out that in the case of Flipkart, unlike common perception, it is not as if Flipkart is buying goods for 100 and selling them for 90. There might be certain offers that they come up with where such a thing might also seem to be true, but largely they are selling goods that they buy for 100 at greater than 100. However, the reason they are making loss is because there are so many other costs, right? Establishment costs, logistics costs, employee costs, etc., etc. So the idea here is that as you keep increasing your size, namely your revenues, in the case of Flipkart, there will come a point of time where as a percentage of your revenue, the other costs will reduce enough such that you become profitable. So that is the basis for something like Flipkart. The basis for something like housing is actually quite different, because like you rightly said, that the revenue model itself is not clear. And you are right, this is how housing is different from something like Flipkart. Pretty much like I must point out that WhatsApp is different from Facebook, because WhatsApp has no clear revenue model, because paying it $1 or 50, 60 rupees per year is not going to give them any money compared to the billions of dollars Facebook spent to acquire it. The idea here is that if housing is a great product, and if tomorrow they are able to actually list all available property in major cities, which is the target that they are coming up with, and you have no choice as to but logically use housing, at that point of time, many logical opportunities would arise. So for instance, if you're selling an apartment or a home or whatever, an office or whatever on housing, housing knows that you're getting money. Now, there are a lot of things that it can help you with, such as buying alternative property, making investments, or whatever it might be, selling banking relationships for all I care. If they achieve a large critical mass, as the likes of Facebook, Google, WhatsApp, etc. have, then there will be opportunities to invest in them. Now, please note the difference. In Flipkart, I said revenues exist, profits are missing. In housing, I said largely you could say probably not be too untrue in be inaccurate in saying that revenues are missing, which is why Flipkart's valuation is so much dramatically higher than housing's. Right? So investors understand the risk. They are of course taking a risk, and they know that this may or may not happen. Next question.
Yeah. So the next question is by Mr. Aryan Srivastava. The question is, what is the EBITDA multiple range that excites investors while evaluating the traction of a one-year-old company?
Okay, so I absolutely hate discarding a question, but the fact is that if you are the kind of company which is getting venture funded and you are trying to look at your EBITDA, or trying to value a company as a multiple of your EBITDA, there really is not just no range, but I would even go to the extent of saying that unless you were a much later stage company, not 1 year but maybe 5 years, these numbers are not too relevant. And I know that this is jarring to some people who have studied project finance or conventional finance where valuations are taken as multiples of revenues or EBITDA or PAT or some other such thing. And I think that going forward, the older methods of valuation such as PAT multiple, EBITDA multiple, discounted cash flow, etc. are relevant. Today, however, what is happening is that since I am investing with the hope of capital appreciation and valuation appreciation, as opposed to sharing in your revenues and profits, the method of, let us say, valuing a company are not based on EBITDA multiples. For instance, there are actually companies worth hundreds of millions of dollars which have no EBITDA, as in they have no earnings. Forget earnings before income, blah, 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 depreciation, tax, etc. They just do not have any form of revenue at all. Even they have significant revenue, and that is because this paradigm of investment is very different than the paradigm of investment you would have, let's say, in a stock market. In a stock market, your question would have been very relevant. Even there, let's say take the case of private banks, the HDFC's multiple might be much higher than ICICI's, and ICICI's will still be dramatically higher than a public sector bank. So even there might be ranges. But in the case of venture capital firms, this question cannot even be asked. Okay, next question.
Yeah. So the next question is by Janil. As an investor, what is the level of experience of an entrepreneur of a pre-seed startup in a field that you require? What if they don't have any experience in the field but a great idea? How would you suggest we can start?
Okay, you've asked two questions, and I have two answers for the first and one answer for the second. In the meanwhile, Runa, are you moderating the session? Or Ashwini, who is moderating the session?
Yeah, this is Ashwini.
Ashwini, so you will have to keep track of time. We are very close to the ending time,
Sure.
so you decide what is the last.
Yeah,
So first part of the question related to the level of experience. What I'll do is I'll correlate experience as well as age. So somebody could be 30 years of age and have no experience in the field they are setting up a venture in, but they could have other work experience. And there could also be somebody who has no work experience at all for all practical purposes. So there are pros and cons. So for instance, I have found that in 2013, 14 and the beginning of 15, a lot of VCs are quite open to funding entrepreneurs who are 20, 21, 22, 23 years of age, which means less than 25 years, which means with zero or close to zero work experience. So examples of Ola and housing are probably quite well known in that space. Unlike, let us say, something like Flipkart, where the entrepreneurs had significant experience. Now, the reason this was done is because investors expect a very, very high growth. People who have a lot of corporate work experience could be the kind that do not have the ability to grow at that rate because they are too overcautious. Having said that, I'm noticing a change of trend towards the second half of 2015, where so many of those companies set up by the 20-somethings or kids, if I can use that term derogatory, so many of those companies are facing such huge problems that you hear tiny owl did blah 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 and such a thing happened, that somebody who has been in the workplace for long would feel these were very highly avoidable problems by somebody who had work experience. So this is about experience in general. Now your second part of the question about I want to set up a startup where I don't have direct experience, how would an investor feel if my idea is fantastic? Okay, first let me put some doubt in your head that the idea might sound fantastic to you. It may not sound fantastic to the investor in the first place. If it does sound fantastic to the investor, they may actually consider putting a small token seed investment despite the fact that you don't have experience. However, why put yourself in that doubtful position? If you don't have experience in a space, why don't you go ahead and gain some work experience? Now, by that, of course, you could go and take employment in that space and spend years and months and gain it. But even if that is not appealing to you, you could do something. You could do a project. You could, roll out something and see how customers respond. Create some amount of credibility, because without that, without some amount of belief that not just is this idea good, but that you are the right person for the idea, very few people will be interested. Let me put it this way. I know of at least 10 fantastic ideas, right, which I would like to invest in. But even if you came to me with one of those 10 which I regard as fantastic, there is a very low chance I would invest in you just because your idea matches with something which I think is a fantastic idea. Because the fact is, think of it this way, just a good idea will never make a great business. You want proof of that? Flipkart was probably the 1,000th website that came, that e-commerce website that came into India selling books. That's why it was called Flipkart, because it was into e-commerce of books. But Flipkart became Flipkart. The first 999 did not. So the idea was identical. It was the people and their experience and their execution that made all the difference. So do not give that much importance to your idea. Of course it matters, the market size matters, but if you are not the one who can take it further, don't expect people to reward you with money because you came up with a great idea. Because look at it this way, some of the most successful Indian startups are actually copies of startups abroad, right? So how much value is there? And that just means you went and read some publication and found out something happening abroad. Do you want to take the next question, Ashwini, or are we done for today?
Maybe 2 more questions. Will that be possible? Okay. Like, I thought we can just extend till 4, 5.
Possible and fine for me.
Yeah.
Okay, it's up to you.
Sure. So this question is by Mr. Wasim, and his question is: what investor invest into an educational marketplace? Why there are very low number of educational marketplace in India?
Okay. So I'll quickly respond in 2 levels. One is about education in general, and second is the more specific part of education marketplace. The problem with education businesses is that they tend to be very high friction because they involve operations with teachers, students, etc. Of course, you could set up an e-learning, e-testing kind of website. The problem with those is that in the form of e-learning, the best that startups have done really is get into some sort of video format, which customers are not buying, and e-testing, data analytics, etc. Customers are buying, but their willingness to pay is very little. However, your question was more about an education marketplace, where people are potentially selling courses, people are probably connecting tutors to students, people are probably selling educational products, books, videos, other such products. Now, I do not see anything intrinsically wrong with this, but pretty much like the question that I have to ask is, what is it about education that requires a website specifically dedicated to it? So for example, if I were to ask a similar question about home cooked food, why should Hola Chef be Hola Chef and Flipkart and Snapdeal not sell home cooked food? You can easily answer that by saying that the characteristics of home cooked food, the life about it, and the fact that it should be delivered in 20 minutes, etc., makes Hola Chef a very different business than something such as Flipkart or Snapdeal. But when it comes to the education marketplace, I have not yet come across very compelling differentiators that an education marketplace will have, which can't be fulfilled in general marketplaces. Right? Of course, I might be wrong, I might be narrow-minded here, and you might have an idea which differentiates your marketplace from the other. That is a good starting point. The only other thing I would say is that in this marketplace, I don't know who your participants are, but if formal institutes of education such as schools, colleges, etc. are also going to participate, I have found a very low degree of professionalism by formal institutes of education, and even something as simple as accepting fees online and stuff is sometimes very difficult for them. Right? So in light of that, you just have to do 2 things. One is you have to tell me why an education marketplace by itself makes sense as opposed to the general marketplaces. And second, you have to show me that all the other participants, the sellers, buyers, enablers, exist in large numbers and have a fairly high degree of readiness to participate. I think that then there is no reason for it to not be a successful business. Ashwini.
Yeah, so I think we are running short of time. So I think we can wind up the session, Ajeet. So thank you so much, Ajeet, for spending time with the
let me
audience?
just give some
Yeah,
closing remarks. Let me
sure,
give closing.
sure.
Hey guys, it was fantastic having you here. I can on my dashboard see that there are presently 149 attendees, which I must say is on an extremely high side compared to some of the things we have seen. So I am grateful to you for having spent close to an hour listening to what we are talking about. Thanks for this. Here's the thing. You may like some of what I said, you may dislike some of what I said. You may find it helpful, you may not find it helpful. That's not important because evaluating me, though it is important from the point of view of knowing whether this session was good, but immaterial from your career's point of view. What I would like to leave you with is, if there are some things that I said which affected you positively, negatively, you like them, you dislike them, work on them. See how you can gain from them, how you can adapt to them. If this does some of the things I said do not work for you, that does not mean you have to get disheartened. There is no one type of entrepreneur. There is no one type of investor. Like, I must say, there are companies which I find like absolutely uninvestable, and then I find some of my best friends have gone and invested in that, right? So do not get discouraged or disheartened. In fact, one of the most important characteristics of a successful entrepreneur is that they go out there and fight and succeed. Make sure you have that fight in you. That would be my closing remark to you, along with the fact that this is a great time to be an entrepreneur. Make sure that you don't miss out on the opportunity.
Thank you so much, Ajeet. That was extremely motivating. I'm sure all the listeners had, got a wonderful opportunity to listen to you and grab a lot of ideas and, move on with their business. So thank you, everyone. Thanks a lot. Follow NEN and Vadwani Foundation. Thanks. Have a good day.